Guys who don't know me, my name is Haley Gant. I'm one of our certified IRA specialists, and I work in our marketing department and help to put on all of these events and webinars for you guys. So I am super excited to have with us today Mr. Fred Moskowitz, and he is going to be speaking about due diligence when you are investing into mortgage notes. So great topic. It's a really popular investment option that we see here at Quest. But before we get started with today's presentation, I do just have a couple of quick slides for you guys. Just a quick little intro commercial about who we are at Quest, what we do, and how we can help you out. And also, I know if you have watched our webinars before, you've probably seen my first few slides that I have. But be sure to pay attention. We do have some big upcoming events that I'm going to talk about at the end of my couple of quick slides here. So be sure to still pay attention. Now, for those of you guys who may not be familiar with Quest, we are a self-directed IRA custodian. We're based out of Houston, Texas, but we do have clients all across the country. We do hold about $2 billion in assets under management. And all of this $2 billion in assets is alternative assets held in IRA accounts. So our clients use their IRAs to invest into real estate, notes, private placements, all of these different alternative assets that most Americans don't know that you can hold in in an IRA. Now, we do have a quick disclaimer here. Quest does not provide tax, legal, or investment advice. This presentation, just like every other presentation that you see us give on our platforms, is strictly for educational purposes only. Please be sure, do your own due diligence, work with professionals, take the time to make sure that you are researching who you're working with and that your deals are structured properly. Gotta say it, cannot stress that enough. And what do you know? Today we're talking about due diligence, so kind of lines up right there with that. Now, the IRAs that we hold at Quest legally are exactly the same as any IRA that you might have at any other custodian. The only difference really is the types of assets that your custodian allows you to invest in. So like I was saying, we hold about $2 billion in assets under management. All of that is alternative assets. We don't hold stocks, we don't hold mutual funds, we don't hold any sort of publicly traded assets. So it really allows you to truly diversify your retirement portfolio. You know, if you're investing in real estate, you're building up assets, you're probably going to be in a slightly higher tax bracket. There's just no way around it. It's really important that as you are investing in real estate and you're building wealth and you're building up your multiple streams of income, that you hold at least some of your investments in an IRA. Because our IRAs get really awesome tax advantages that we don't get as individuals. Now, I only have a couple of quick minutes before we really get into today's presentation, but I would definitely encourage all of you out there, if you are interested in this, learning more about the concept of it, how it works, you know, what types of accounts you might be able to use, reach out to an IRA specialist. It is always free to talk to us. Our IRA specialists have gone through some pretty rigorous training. I've been at Quest for about 4.5 years, and a lot of our other IRA specialists have either been with the company for several years or they have backgrounds in finance, business, and real estate as well. So we're always here to help you. You know, we're actually investors ourselves. I invest into real estate. So does my family, kind of how I ended up here at Quest. But again, reach out to us to set up a free consultation. There are actually 7 different types of accounts that we hold here at Quest that can be self-directed, anything from your personal plans, the employer plans that allow for much larger contribution limits. And last but not least, these specialty plans, you can actually self-direct them just like all of our other IRAs, but the money can be used today completely tax-free for your health expenses and your children's educational expenses. So there's a lot of different ways that these IRAs can be worked. They can be partnered together. You know, most families, most clients that we have, they don't have just one account. They might have a Roth IRA. They might have a traditional IRA. They might have a health savings account. And you actually have the ability to use all of these accounts together on your deals and grow multiple buckets of money at the same time. So again, be sure to reach out to us here at Quest. We are always here to help and here to answer all of your tough IRA questions. And these are just a few of the many different investment options that you have. today we are going to focus in on promissory notes. So you can hold all of these types of assets in an IRA, but notes is a really popular investment option. It's actually almost about half of the transactions that we fund at Quest are either people using their IRAs to be private lenders or purchasing existing notes, which is a really popular option because it's totally passive and you can kind of build up that mailbox money. Now, the process of getting started investing, getting the money in and out of your IRA is pretty straightforward. We'll walk you through the whole process step by step. It's definitely not as complicated as it may seem. But I want to kind of just skip over that because I do want to talk about some of our upcoming events that we have. So, this is just one of many webinars that we host at Quest. All of our classes can be rewatched at any time on our Facebook page and our YouTube page as well. So we host webinars every single Saturday, Tuesday, Wednesdays, Thursdays. We also have a virtual networking happy hour that I actually personally host myself. Guys, I know with COVID, we can't go to as many in-person events as we used to. Some of them are starting back up, but most places, we are all missing that networking, meeting people aspect of this business. So this virtual networking happy hour that we host was kind of basically started out of necessity and me getting calls almost every single day of people asking us, I miss the networking. When are you starting up your in-person events? And, since we're not able to do that right now, we've started this online happy hour. Fred has actually joined us several times for it. A lot of fun. It attracts investors from across the US. And basically, everyone gets a chance to introduce themselves, give a quick little elevator pitch, and then we open up the conversations at the end. And it's been a lot of fun. There's been a lot of people that join every week. There's a lot of new people, and it's a great place to meet other investors. Now, remember, we don't endorse or recommend any individuals. We can't provide you deals, but hopefully this helps to continue to start those conversations and help you guys meet other valuable people that can be, a good part of your network as well. So reach out to us, subscribe to us on YouTube, check out our other classes, and our two big events that we have coming up for this spring is our a 3-hour online CE course that we host for real estate agents. This will be February 18th. It is a totally free 3-hour course, and it is an in-depth 3-hour class all about self-directed IRAs, the types of accounts. We have several case studies. And even if you're not a real estate agent, anyone can take this class. Again, it's totally free. If you want to go ahead and scan the QR code, it'll take you to the Zoom registration page. It takes about 30 seconds to register, but be sure to do that. These courses actually fill up. We get several hundred people that register for them. And through Zoom, we can only have the event be so large. So be sure to get that registration there. And if you have questions, just let us know. And last but not least, we have QuestCon Live coming back this April. And this QuestCon will be our private lending edition. So very similar to the last events. It's a full 2 days. It's a Friday, Saturday, and it's right after tax filing deadline. So, not doing it before like we normally do. But, once you get those taxes done and you want to learn a little bit more about private lending, be sure to come join us. Tickets are on sale now. I'm sure we'll have some discount codes that we're putting out there in the future, but just kind of a little tidbit there. Be sure to join us and be sure to mark your calendars. If you have questions, it is always really easy to get a hold of us. You can chat live with an IRA specialist at our website at any time during our business hours. You can give us a call or send us an email at iraspecialist@questtrust.com. You guys have probably noticed that here in the chat, I do actually have Nicole Bako, one of our other IRA specialists, moderating with me today. If you guys have questions, let us know. Reach out to either Nicole or myself, and be sure to check out those links that she has put in the chat for you guys. So that is all I have. Without further ado, I want to go ahead and pass it off to Mr. Fred Moskowitz, joining us here from Philadelphia today, actually. So hopefully it's not too cold up there like it actually is kind of in Texas right now. But Fred, I'm so excited to have you here with us today. The floor is yours. Go ahead and take it away.
Thank you, Haley, and thank you, Nicole. It's my pleasure to be here today speaking to the Quest community, and I had so much fun presenting in the past, and I'm honored that you have me back today. This is fantastic. And as you mentioned before, with self-directed investing, a huge component of that is your due diligence and evaluating an investment. Because remember, your IRA custodian is not allowed to endorse or give an opinion on any investment. It's all on you. So as the investor, you have to remember, in a self-directed account, the word self, it really means that it's on you to do that due diligence. So today I'm going to share with you some different strategies and ideas all about due diligence when it comes to the context of note investing. And it doesn't matter if you do individual note investing in your account, or if you are seeking to invest in a note fund. So we'll talk about both of those aspects today. I'm going to set up my screen share here. Great. So today we're going to talk about due diligence when it comes to investing in notes and mortgages. I'll just give a quick overview of what note investing is, in case this is a new concept to anyone in the audience today. Note investing is the practice of putting out your capital into an investment in return for a rate of return on your investment. It's lending, the lending of money. And that can be either through originating a note, where you are originating that loan, or you're buying an existing note, which is more of what I'm involved with, which is buying notes that exist already. And note, the business of lending and debt and investing in debt, it's been around since biblical times. It really has. And one of my favorite aspects of note investing is that you can do it where the note is secured. In other words, the note is backed by collateral and you have a tangible asset protecting your investment, right? Everyone is familiar with notes and mortgages from the perspective of being the one making the monthly payments, because you took out a mortgage when you bought a property, you bought your house, or you bought a vehicle, right? And you got a car loan. So imagine, what would it be like if, instead of being the one making the monthly payments, you would just step across the aisle to the other side and be the one receiving those monthly payments? Imagine what that would be like. Well, that's what note investing is all about. And let's take that up to, if we next level that idea, if we combine that through self-directed account investing so that we can realize all the tax advantages, now that is a powerful combination. It really is. And I'll get more into that in our discussion today. So the first topic I'd like to have you think about is, are you looking to invest in individual notes, or are you looking for a note fund? And there's some different characteristics, different reasons why you may like one or the other, or you may find that one approach suits you better than the other. But in reality, it's one simple question that you have to ask yourself. How much time do you have? And how much time do you want to dedicate to being involved in note investing, right? If you love the idea, you think it's a fascinating business, and you want to be deeply involved in note investing, then the right approach is active investing. And what I mean by that is, you are fully going to be involved in the business. You're buying notes individually, or maybe you ramp up to the point where you're buying pools of notes, or you are becoming a lender, private lender, originating hard money loans for people that do fix and flip properties, another very common business model. Those are all under the umbrella of active investing. And contrary to popular belief, it takes a lot of time. If you're going to be successful in this business as a note investor, it does take a lot of time, and you have to be prepared for that. Now, the other side of the coin is passive investing. Passive investing is another approach. This is the approach where instead of buying individual notes, you would be investing in a note fund. And that way, you have very little time required beyond your initial due diligence. So you do your evaluation, you do your due diligence, you make sure that the investment is appropriate for you. And then after that, there's really very little involved for you as the investor. That's what makes it passive. There's no right or wrong answer here. It comes down to what you want, what are your objectives, and the lifestyle you have. If you are a busy professional, for instance, you have a successful career, or you have you're a business owner, an entrepreneur, you probably don't have a lot of time and you would prefer to be a passive investor, right? So things like note funds or real estate syndications, those type of investments would be more appealing to you than to be investing actively, where you're looking for notes, you're marketing for notes and scouring the secondary market to buy them and do the acquisitions. So those are the main differences. So active note investing, let's unpack that a little bit. So for active note investors, you are going to be focusing on note sourcing. You're going to have a marketing strategy. I know some people really like the idea of buying seller finance notes, and you're doing marketing. You're sending out mailings and postcards, buying lists of note holders, marketing to them, right? Or if you're buying notes on the secondary market, you're going to be doing that note sourcing work, which is a lot of networking, building of personal relationships with hedge funds and lenders to be buying notes that are on the secondary market. The next category is your due diligence, all of your pre-purchase due diligence, evaluating the notes, the borrowers, doing your underwriting of the deal. Those are all things that you'll be heavily involved in. Next is vendor management, right? Vendor management, the vendors for the note business, which are primarily note servicers, your legal counsel, keeping in mind that you have to have legal representation in every state where you're buying notes, where the property are located. And then all of your data vendors. There's multiple data vendors that come into play that you'll be interacting with. You'll be utilizing their products, and that becomes part of your note business, because there's a lot of research that goes into evaluating notes. So the data vendors are a key component of that. Now, one of the downsides of active note investing for someone that's starting out is there's going to be less diversity for you. And what I mean by that is you might be looking to buy one or two notes, right? And you go out and do that. Well, now how much risk do you have? Because all of your capital is spread out over one or two assets. So if there's anything that ever goes wrong, or a default or anything that happens, now your capital is at risk, and you have to work on that to manage that. So it's just something that I want you to be mindful about and be aware about. And the last point is that active note investing is better suited to anyone that has the time and an interest to be hands-on in the business. It's a great business. It's fantastic, but you have to realize what it is you're signing up for and be okay with that. So go into it with eyes wide open. So let's transition over to passive note investing, and you'll see some sharp contrasts here. With passive note investing, the one thing that you're relying on as the investor is the fund operator and their team, because they're going to be handling a lot of the workload for you, for the investors. That's what makes it passive. So the fund operators, they're responsible for your note sourcing, acquisition of those notes. They're going to be doing the due diligence and the underwriting, which is very important. They're going to be managing that note portfolio on an ongoing basis. This is key. You have to have a lot of eyes on your portfolio to make sure that everything's being handled properly, things are working. This is not a set it and forget it type thing. Also, the diversity is key. With passive note investing, when you're investing in a note fund, instead, as I mentioned earlier, instead of your capital being invested into one or two assets, right? Let's say you invested $50,000 or $100,000 into notes. Well, instead of one or two notes, your $50,000 could be spread out over a diverse asset pool. And that could mean over hundreds of notes or thousands of notes. So let's take a page from the playbook of insurance companies, because this is exactly the business model they use. Insurance companies know what they're doing, right? They really know what they're doing. They know how to stay profitable. They've been in business, some of them for hundreds of years. And the way they manage their risk is by insuring many, many insureds. They write many policies over thousands and thousands of people, and there's a lot of diversity, and that helps with their risk management. Because yes, there may be some claims that they pay out from time to time, but overall, the overall pool protects their capital that's invested. And this goes for life insurance policies, for auto policies, for homeowners insurance policies like fire and casualty, for property. It all runs on these similar models. So learn what the successful insurance companies do and see how you can adapt that into your own investing. The last point is about passive note investing, that this is ideal for anyone that does not have does not have much time, right? They have less time available, and they do not want to be hands-on because they want to be able to focus on their business. They want to be able to focus on their career, their professional career, and do well with that and advance that, or their own business as an entrepreneur or business owner. So let's talk about considering your investment goals and objectives. Before you invest in notes, whether it's individual notes or a note fund, think about your investment goals and objectives. This is so important. And a lot of this carries over to any asset class, not just notes, right? So think about, the first is your time horizon. What is your time horizon? Are you many, many years away from retirement, where you're going to be the time that you're withdrawing from your IRA, your self-directed IRA account? Or are you just a couple of years away that you're going to be withdrawing those funds? That's a very important consideration. Now, with note funds, they are set up with all different kinds of time horizons, and there's no right or wrong answer. It's just that you have to find what's right for you and your individual situation. So you have to consider this. And actually, all of these goals, it's the same thing. You have to consider what's going to be best for you and your own situation. Is very individual consideration, right? The next is risk tolerance. If you are many, many years away from needing those funds, then you're probably going to have a higher risk tolerance than someone that needs that money in just a couple of years. And so that's going to be dictating accordingly what you're going to do. Are you going to maybe invest in a note fund that takes a little more risk and pays out a higher rate of return? Or would you be better suited in a note fund that's more income focused and takes lower risks, and they're seeking to be in a better risk management position, but they're paying a lower return, and that may be better suited for you? Again, there's no right or wrong answer. You just have to consider this, think about this carefully, and you'll find that there's note funds that cater to both needs, right? So just find what's right for you. The next characteristic is, how are returns paid out, right? Are you earning a straight rate of return each month, paid out monthly, and then at the end you get your capital back and that's it, right? That's one way. And then there's other models for note funds where they do a profit split at the end, right? Where you get paid out less, or maybe nothing at all. Maybe everything's deferred to the end, but then you get to share in some of the upside. Again, it's part of that risk. How much risk are you comfortable with, and what are you looking for? A lot of times people like the idea of a profit split at the end, because one of the unique things is that you end up having aligned interests between the fund managers and the investors, because if the fund does well, then there's going to be higher profit payout at the end, and that keeps everyone's interests aligned, especially during difficult times. So that's an interesting consideration and something to think about. The last point is the accreditation status. Note funds, well, think about whether you're accredited or non-accredited. And I'll talk about that briefly. An accredited investor, there's a test called the Edgar test, where you have, and this is through the SEC guidelines. If you go to investor.gov, you can look this up in detail. But there's an accredited investor test. And basically what that means is that if you have one of the two criteria are met, if your income is above $200,000 a year, or if you have a net worth of over $1 million, not including your primary residence, then you are an accredited investor. You don't have to meet both criteria. You can pass the test either through income or through net worth, and then you're an accredited investor. And if not, then you're known as a non-accredited investor. Now, if you're buying individual notes, you don't need to be accredited. Anyone can buy individual notes. If you're investing in a note fund, you need to ask whether the note fund accepts accredited or non-accredited investors. And it just depends on their structure, their entity structure, and how they registered with the Securities and Exchange Commission. But this is important because you don't want to waste your time talking to a fund manager and considering a note fund if they only accept accredited investors and you are not accredited. So you need to find one that fits your profile and do that early so that you're not wasting your time or anyone else's. So that's a little bit on accreditation status. So with notes, there's several subcategories that you'll hear about. And what you'll find are that note funds are usually going to focus on one of these classes, these subcategories. You have residential and commercial, and maybe one or the other, or a mix of the two. There's also secured notes and unsecured notes. And what that means is secured notes are backed by an asset, right? They're mortgages that are backed by real estate. Unsecured notes are things like credit card loans, or what's another category? The merchant cash advances. That's another category, which are business loans, but they're unsecured. things like that. There's credit card debt, which is unsecured. So there's just different categories there, and you may run across these. Another area is performing notes or non-performing notes. Note funds may focus on one or the other, or both, actually. So you'll consider that. Performing notes obviously have a lower risk profile than non-performing notes, which are going to take on more risk. Now, your risk management considerations. This comes into a note portfolio. Again, goes for individual note investing or a note fund, right? You have your geographic diversity of assets. Where are the notes located? Where are those properties located? Some note funds invest nationwide, which is nice because you have a good geographical diversity. I've seen other note funds. For instance, here's an example. There's one that invests in California only, hard money loans. That's all they do. That's their niche. They do that really well. They focus on that, but that's it. That's all they do. So that's more of a limited specialty. Nothing wrong with that. Just understand that if you're looking for diversity in your portfolio, I know a lot of investors that want to make sure that they like note funds, but they want to have different focuses and spread their capital out among different ones. They'll invest in a hard money fund, they'll invest in a performing fund, and they'll invest in a non-performing fund that invests nationwide. And that gives them a good broad overview and good diversity across their portfolio. Next, this is a very important one, is I want you to check the fund structure and the SEC status of the fund. This is very important. There may be some operators that are cutting corners and not doing everything properly, and you can really get in trouble with regulatory bodies, the SEC. This is so important. The SEC is a government entity, the Securities and Exchange Commission, and their main job is to make sure that investors are protected. And one of the fantastic services they do is that they serve as a watchdog all across the US, looking at all the investments, all the publicly traded investments, private offerings, to make sure that investors are protected, to make sure that the investments are held to a standard, right? So you want to ask about the SEC status. The most popular ones are Regulation D 506 offerings. That's what they're called. You can look up on the Securities Exchange Commission website and read up about this. What you're going to find usually are 506B, 506C offerings. They're the two most common. Those have different characteristics to them. And you want to make sure that if you're considering a note fund or any real estate syndication, that it falls under one of those two categories. And also take it a step further, go to the SEC and check yourself, right? Don't take it for granted. You can call, you can check on the status, you can check if there's any violations or complaints, and that's going to help you. That's part of your due diligence before entering into an investment, so that you know what your risks are and what you could be getting involved in. I've seen this too many times, unfortunately, where people got involved into an investment and things didn't go well. And this all could have been avoided if they did some of their homework up front. The next consideration is vendor diversity, right? You want to look for vendor diversity with respect to the vendors used in managing notes, the note business, your note servicers, legal team, business practices, all of that falls under vendor diversity. So let's talk about investment sponsors and fund managers, and this can go for note funds as well as real estate syndications. How do you do your due diligence when you're considering a deal, right? I don't want you to be one of those people that screens a tenant for a rental property a lot deeper than they screen a investment sponsor when you're getting ready to hand over 50,000 or 75,000 or $100,000 into a syndication or a fund, right? Think about that. You really want to do your homework. And if this is something that it's new to you, get help, get professional help to hold your hand and guide you on the journey. But here's some of the main areas to focus on, right? Do background checks, run background checks on the entity, on the individual sponsors of the investment to make sure that everything's clean and that they're doing business in an ethical and honest manner. Very important. I've seen people get involved into these nightmare situations that if they would have only spent 10 minutes doing Google searches on someone's name, it would have saved them a whole lot of trouble. And I really mean that. That's the very basic, right? Just spend some time doing Google searches, but don't be afraid. Spend a little money, get background checks run, and just pay for it as part of your due diligence costs. It will be money well spent. And if the end result is you don't move forward with a deal, well, let me tell you, that money you spent on due diligence was the best money you've ever spent. That's going to give you the best rate of return ever than if you would have invested a huge chunk of capital and have it lost or have it tied up or just getting you into a bad situation. So that's enough on that. Next is experience and expertise, right? You want to explore that, ask through your conversations, and get an understanding on that. Next, reputation in the industry. In the note industry, it's a small world. We all know each other, all of us that are active in the note industry. So it's easy to ask around and get some opinions from people, from anyone else. Along with that are referrals and references. Don't be afraid to ask someone you're talking to about a fund for referrals and references, and they should be able to provide those to you. So this is nearing the last slide. I do have some final thoughts about your due diligence process. One of the most important ones that I want to continue to hold out there, right, is your tax consequences of the investment. This is key and so important, and it's going to be different for every person. This is a very individualized situation, but you want to ask, what are the tax consequences of the investment if you participate in it? Right? If you invest in a real estate syndication, you probably will be getting a K1. And are there going to be tax depreciation and write-offs that flow down to you that you can benefit from? That's a great thing. So ask about that, and you need to consult with your CPA before investing, to understand what are the tax consequences and benefits, right? It could be good, it could be bad, but you want to go into it with your eyes wide open and know what that is. If you're investing in notes, and with the fund I manage, this is a conversation I have with every investor, right? What are your tax consequences? Because if you're doing this out of a self-directed IRA, there's a lot of benefits because notes generate tax liability. There's no two ways about it. That's part of note investing. You have interest income and capital gain. So if you can combine this with a self-directed IRA, or even better, self-directed Roth IRA, it's very powerful benefits to you. So understand those tax consequences. Do a consult with your CPA, with your tax advisors, and just talk through it with them so that you know what's going to happen. I do not want you to end up with any surprises when you get a K1 at the end of the year and realize that you're going to be having a tax liability out of it that you weren't expecting. That's the worst situation to be in. Another thing is building relationships. When you're talking to an investment sponsor, are you going to be building a relationship with them? I hope so. And I hope it's a long-term relationship and not a transactional one. Because let me tell you, if things go well, then and you get your when you get your capital back, you're going to immediately want to put that back to work again. So if you have a good relationship established with your investment sponsor, you can do something else. You can start having a conversation. Hey, what's next? What's the next thing you have lined up? Can we partner up together again? And that continues on that long-term relationship. I know of relationships, especially with self-directed IRA investors, that have gone on for 20 and 30 years, and everyone benefits so much. So relationships are the most powerful thing. And if you're looking to build relationships, one thing that Haley mentioned earlier are the Quest networking happy hour events. They're fantastic. Explore that. Spend some time, join them, and attend and see how it is for yourself, because that's this forums where you can build relationships. You can attend networking events. Quest does such a fantastic job of putting on events and conferences. Make an effort to attend and benefit from that. If you are a customer of Quest, you have this all available to you. Take advantage of that. Take note of those opportunities. I really encourage you to do that. And then education, another area. Always invest in your own education, because an investment in education is key. I'm a Philly guy, right? That's me. And being a Philly guy, I like to turn to one of the founding fathers of our nation, Benjamin Franklin. And here's one of my favorite quotes from his is that an investment in education, in your own education, always pays the best dividends. And you know what? That's so true. So I encourage you, set a line item in your own personal budget each year with money and time to dedicate on your own investment in yourself. Attend conferences, take courses to learn. These things don't get taught in school. So don't be afraid to book a flight and travel down the Quest when they have their event and network with people and learn, because this is going to pay off huge for you. Always be seeking to invest in your education. There's so much out there, and this is all stuff that unfortunately does not get taught in school. So it's on you to take initiative and learn. I'd like to share with you a couple of resources. These are some of my favorites. They're all around note investing. The first is a great book. This is what turned me on to note investing. This is written by the granddaddy of note investing, Jimmy Napier. His book, Invest in Debt, it's excellent. He goes into so much detail there. He spends a lot of time teaching you how to utilize a financial calculator, which is a very important tool in note investing, by the way, right? And speaking of financial calculators, the two best ones, the classic HP 12C, that if you're old school and this is the workhorse, been around forever, or if you prefer to have an app on your smartphone, you can try out the 10BII smartphone app. I use it all the time. It costs $6, and it's the best $6 you could ever spend. I promise you that. For $6, you have this app. It's always with you. You can analyze cash flow on rental properties, on notes, on a note fund, anything you want where you have cash flow to analyze. It's a great tool, and it's the best value at $6. So check it out. Another book, is the little green book of note investing that I wrote, and it's releasing now. I encourage you to check it out. I share so much more in that book. And for anyone attending today's webinar, feel free to visit my website. You can go to giftfromfred.com, receive a special report about note investing where I get into a lot more detail. And now, in closing, I'm going to open it up for some Q&A. And I'd just like to say in closing that I don't have a lot of time with you today, and that's very unfortunate. But I do if you come to me. I have a lot of time for people that come to me. I love speaking with investors. I love talking about note investing. It's a huge passion of mine. So I look forward to connecting with you. I'll share my contact information, or come to the next Quest networking event, and maybe we can see each other there. I'd like to turn it over to Haley to do some Q&A for some of the folks that have questions on the chat. My contact information is here. Again, I look forward to meeting you at a Quest event in the future, or contacting offline. Thank you.
Awesome, Fred. Thank you so much. So much great information offered. And, kind of like you were saying, it's just the tip of the iceberg. Guys, be sure to take advantage of some of these other resources. Be sure to text the note, the number there on the screen. But we do have several questions coming through the Q&A box, so we are going to try to answer as many as possible. I will let you guys know sometimes if the question is really long or really specific, maybe would recommend reaching out to Fred afterwards to have a more in-depth. But let's go ahead and get a few of them answered. Bill wants to know, Fred, do you prefer buying existing notes versus originating notes? Why, and what are the pros and cons?
I do. I prefer buying existing notes. It's just a niche. It's what I learned. I like the idea that banks and lending institutions did the individual underwriting initially of the loan, qualified the borrowers. That's really good. With owner finance notes, you don't know who originated the notes and what their process was when they did that. What was the underwriting like? Did they engage the services of a licensed loan underwriter, which is actually a compliance thing that's supposed to be done if it's an owner occupant property? So those are some of the distinctions. There's no right or wrong answer. I know many investors that do one or both, and they have their preferences. But you just have to see what's right for you.
Mm-hmm. Awesome. Great information there. This is a good one that I had actually written down myself as well. But give us a little bit more information. How do you do your background checks on funds and people? Are there any particular services that you use for this? Kind of give us a little bit more info here.
Yeah, definitely. There's that's a really great question. There's a few different services. There are private investigators, which can do a lot, right? As much or as little as you want, depending on your budget. That's what I would start with first. There's services like TransUnion, TLO, that are more keyed in towards this. You may or may not be able to have access to get that. They do have some thresholds set before they will allow people on their platform, but you can always go through a private investigator who will do that for you. So it just depends. If you're doing this a lot, then definitely look into a service vendor like TLO or TransUnion or NexusLexis. They all do this type of work and offer different products that will suit your budget, right? If you're going into, here's an example, like let's say you're a business and you're doing some kind of a partnership with another company or doing an acquisition, right? You have to almost do this level of due diligence. So that's where it would warrant going to Nexus Lexis and looking at their product offerings, because it's going to be very expensive, but the dollars are big here, right? You're putting a lot at stake when you're acquiring an existing business. So you want to do this right. And they're really focused on that. So it just depends on your own individual situation. But that's a good overview of some different options for you doing that.
Yes, definitely. And depending on your needs, how often you do it, there's definitely services out there, but it's so important. And just to kind of piggyback off of what you said in your presentation, Google searches, you can find a lot of things on the internet. Just kind of like a tip for everyone out there. Like, for example, at Quest, like anyone that we work with, I actually have a vetting process. So I Google their name and fraud, their name and court cases, their name and ripoff report, the business name. Make sure you're searching both of those things. But a lot of times, if you add those keywords in there, like fraud, ripoff report, court cases, things of that nature, or even like bad reviews, if there's something out there, it'll come up more at the top of the search. So that's a great free way to do it. And, you want to make sure you're doing those multiple searches.
That's a great point, Haley. Yeah, absolutely. It's so important. I can't stress that enough.
Yeah, definitely. This is a good question here. And I actually don't know if I fully know the answer to this one myself, but can investing into a note fund result in UBIT or unrelated business income tax? Do you know if it would?
It could. This is a little bit nuanced. So I'll give a general answer, right? But you need to review with your CPA. If the fund takes on debt and works with debt, then it could possibly. But if the fund raises capital and does all of its acquisitions in cash, then probably not. There's not going to be UBIT involved. So that's the top level, high level answer. But that's part of the discussion that you need to have with the fund managers as part of your due diligence, to have an understanding of what that is and what the impacts could be to you as the investor.
Yes, definitely. And guys, if you want more UBIT resources, reach out to us at Quest. I've done several videos. I'm kind of our in-house resident UBIT nerd, but I'm not the only one that knows about it. So just reach out to us. We do have several videos and resources there as well. This is a good question from Rob. Rob wants to know, can I sell a partial of a partial of a partial note?
Yes, absolutely. You can. Absolutely.
Okay.
Yeah, absolutely. You just need to coordinate that with two people, the loan servicer, first of all, and the owner of the note, the owner of the back end of the note. But you can. And for the benefit of everyone else, a partial is basically when you sell a part of a note. If you have a note with 60 payments on it, you could sell a partial. You could sell 24 of those payments to someone else, and they'll collect those 24 payments. And then on payment number 25, the payment stream reverts back to the person that sold that partial. That's what a partial is. So it's basically just selling part of a note, and it's done to recapitalize. And it's an advanced concept, but a very powerful one.
Yes, definitely a little bit advanced, kind of makes my head spin a little bit personally, but you just really want to make sure that your documentation and your paperwork is really in check there as things get more complicated.
Yeah, you have to coordinate that. The servicer is the key player in that transaction, the loan servicer. I actually dedicated a whole chapter in my book, Haley, to partials, to give a good explanation and a case study, because I think people just don't do them enough. They don't know about them, and it's a great tool. It's a great tool. It's so powerful. So
Definitely
learn about them for sure.
Yes. And even partials, if you are investing with small amounts, partials, that kind of like creative deal structuring could be a great way to grow a small IRA. Again, just make sure that you do that due diligence there.
Yeah, that's a
Yeah.
great point. Especially if you have a small HSA or small Coverdell account, you can invest in notes in that, and a partial is a great way to do it.
Definitely. Yes. We need to do another class on partials. I think we've done one, but it was probably a while ago. But
Uh,
you mentioned the note servicer. Um,
yes.
w- have a question here. When should anyone service the notes that they own, or should I service my own notes? Why or why not?
Well, that's there's a couple of reasons. In some states, it's actually required by for compliance. This is a state specific thing. Some states you're allowed to service your own notes. Um, I don't recommend it because it's a headache. I wouldn't want to do it. There's a lot of work involved. Um, let's talk about note servicers. Note servicers provide such a great service in managing the note and taking care of the payments, keeping track of the accounting, keeping track of the amortization schedule, all of those things. They do the tax forms at the end of the year for the borrower, answer the phones, all of that. I would not want to do any of that myself. And note servicers charge $15 to $20 a month usually for servicing a note. It's such a low cost. Think of a note servicer as just like a property manager is for a rental property. The note servicer is a manager for the note, and they take care of that for a very low cost. It's well worth it. So I always encourage it. It's not required. You can do it if you like, if you want to put yourself through all that work and pain, but just know that in some states it's not allowed. And my opinion is I would put it in servicing. I prefer to do that just because I don't want to take on all that work. Do the work that you're best at, right? Think about that. What's the highest and best use of your time and focus on that. I have a feeling that servicing a note yourself is probably not the best use of your time, but you can do it if you like. There's nothing bad about it. It's just that it ties you up. Right?
hmm
Your time is better spent finding a new deal to invest in, or going
Exactly.
to an event at Quest and participating, meeting and networking people. That is a better use of your time. Wouldn't
hmm
wouldn't you say, Haley?
Oh, yes, definitely. And especially with notes servicing tax forms, the reporting of it, unless you are a note servicer, like that's your business, I would let the person do that. That is their business, pay the small fee, let them do it. Because there's a lot of other benefits to using a servicer as well. Just all of the little things that they provide along with that.
Absolutely.
hmm
Absolutely.
Yes. All right. So we do have time for a few more questions. I will let you guys know we are not going to have time to get to all of the questions here, but I'll try to pick out some good ones that are kind of general. This is a good one. What are the average kind of like projected range of returns for secured notes?
Just to give you an idea, they can be all across the board, right? For secured notes, now this depends on whether property is owner occupied or not, whether it's in first position or second position, junior lien, whether the payment history is good or not so good, whether the payment history is 3 months long or 36 months long or 100 months long, right? But it could be anywhere from let's say 5% up to 15, 16%. It comes down to how much risk you want to take and what works for you. And for many people, the right answer is they'll have different notes, different risks, different rates of return, where it all blends together into a portfolio and averages out your risk. But there's no wrong answer. And a lot of times it comes down to what is available to you at the time when you have capital to deploy, because you may find a great deal, you deploy your capital, and then it's tied up. And now you can't invest in anything else for a while. And so you just have to keep that in mind. But that's the range, I would say, between 5 and 16%.
Hmm. Yeah, so lots of different factors there. And it kind of leads right into the next question from Stephen. Stephen wants to know, do you have any further resources for actually analyzing notes, to consider if it's a good or bad investment?
Yeah, absolutely. There's different trainings available to you if you're analyzing notes individually as an investor. There are some products that automate it for you. I wouldn't rely on that. I would use it just as a tool in your toolbox to help. A lot of them are geared more towards institutional buyers where they have to analyze hundreds and hundreds of notes for one transaction. But if you're working with one note, do the work, push a pencil to the numbers, get that financial calculator, run the amortization table yourself, make sure that the principal balance matches up with the payment number, with the interest rate and the payment amount. Whatever the seller of the note is offering to you as the information, you want to check that all yourself, push a pencil to the numbers, and make sure. If you want to learn more about that, I there's some great books I mentioned earlier. Check them out. There's several books that get into due diligence. The best way to learn is to do it yourself. Practice on some notes, right? You can do that. It won't cost you anything except your time. But what you learn in the process, that growth, is so valuable for you.
Yes, definitely. It's so true. And, it kind of gives me a good idea for a future class that we can do, maybe actually bring in a few case studies and analyzing these notes and kind of walking through it step by step. I did actually send that over to our marketing department. So stay tuned, guys, maybe in a couple months. We work our schedules out several months in advance. So just stay tuned and, maybe we'll have to do that one next time. There's a good question here about capital gains. Yes. So, does investing into notes, can it result in capital gains, or is it mainly interest income that's generated? Can you walk us through that a little bit?
Yeah, absolutely. It actually can generate both. And here's why. What's most typical when you buy a note, you're buying it at a discount. Okay. You're buying a note for less than the amount owed. And this is standard in the note industry. So, what could theoretically happen? Here's an example. Let's say there was a note for $100,000 balance that you buy, right? Let's say you buy it at a discount. You're a good negotiator, right? You learned from the best. You took a negotiating workshop as part of your education, and you got to be a fantastic negotiator. So you got a good deal. You bought a note, $100,000 note for $85,000. That was your purchase price, and it's sitting there in your Quest IRA account, right? And let's say you collect payments on it for a year. The loan balance on that $100,000 loan, maybe it goes down to 99,000 in that year, just as rough numbers. It doesn't go down by much. You collected 12 months of payments, right? That's generating interest income. Okay. But then the note pays off at the end of that year. So what happens? You get a payoff check for $99,000 from the title company for a note that you bought for $85,000. So that means that you have $14,000 of profit. That is capital gain. Since you own the note for a year, it's actually long-term capital gain, which is a better rate than short-term capital gain. But this is how you get a mix of interest income from the payments you received over the first year. And then that extra that comes at the payoff, that's capital gain. So you have to keep track of that and work through that with your CPA. If you own this note in your Quest IRA, there's not going to be any taxes due. But if you own this note outside of an IRA, then there's going to be taxes due, and it's going to be a blend of capital gain and interest income. And if you have the note serviced with a servicer, they'll send you the proper tax documentation to reflect that, which helps at tax time when you're working with your CPA. So that's kind of how that scenario would play out. Does that make sense, Haley?
Oh, yes. That was a great explanation. It was a great question and it was a great answer. And I love that you threw in the part about the CPA and, kind of comparing it to an IRA as well, because if you do have an investment that you think might trigger a lot of capital gains like that, do that investment in your IRA so you don't have to worry about the capital gains. Definitely some things that you want to consider whenever you are initially getting into that investment when you're deciding, do I want to buy it with my own money or do I want to do this investment in my IRA? So great points there. That was such a great answer.
Yeah, thanks, Haley. Yeah, that was a really good question. Could be one of the most important questions that were asked today on this webinar.
Yes, definitely. And to wrap it up, just because we've had about 5 different people ask the same question, do you have any recommendations or names for note servicers that you're aware of?
Yeah, I do. There's many. They really cater to different types of assets, right? I'll name a couple. I'm happy to discuss this if anyone wants to reach out. But I'll give you some of the popular ones that do well with note investors. They do well with note investors that are working out of an self-directed IRA account. So some of the ones that you can explore are Allied Servicing. There's FCI. There is Madison Management. They're some of the well-known ones that they all do a good job. They all cater to specific things. So it does depend on what you need them to do for you. And you have to have that conversation with them to see, but they do well. And the best thing is they're set up to work with note investors that are have notes in their IRA accounts, which is very important. You want all of those transactions to go smoothly and seamlessly so that your life has as minimal headaches as possible. I love that, right? That's important to me. So seek that out. But again, feel free to reach out to me offline and happy to go into more detail on that.
Awesome. And I did put those 3 that he just mentioned there in the chat for everyone. But if you guys have further questions, do not hesitate to reach out to an IRA specialist here at Quest or reach out to Fred. Be sure to check out his other resources that he has for you guys. And be sure to join us for our virtual networking happy hours, because Fred, as well as several other note investors, have been joining us in those happy hours. But they are open to pretty much everyone across the US. Now, we are just about out of time today, but Fred, before we go, do you have any last kind of closing thoughts, statements, word of advice for everyone out there before we sign off for the day?
Yes, I do. I'd like to start with a question. Haley, when is the next networking event?
It is this Wednesday, January 20th at 6:30 p.m. Central Time. It's the first and third Wednesday of every single month. Nicole actually has put those links there in the chat. You can see it right here. But yeah, next Wednesday, 6:30 p.m. Central Time. Grab a beer, grab a glass of wine, and come hang out with us. And we keep it fun, we keep it lively, and you get to meet about 50 investors from across the U.S. in about an hour and a half. So it's a great event. It's been a lot of fun.
Excellent. Thank you. And I'll leave you with this closing thought, something I mentioned earlier. And remember Ben Franklin's famous words: an investment in yourself pays the best dividends. I really mean that. I encourage you, invest in yourself. Do not be afraid to spend money and time on your own education. I make a line item in my own budget each year I dedicate to that. That includes traveling to events and conferences, taking trainings and workshops, and always learning new things. Be a lifelong learner. Take that approach. Don't be one of the people that thinks that when you graduate from school, you never have to open a book again or sit in a classroom again. That's just not the right attitude. Be a lifelong learner, because that's going to serve you so well. I promise you that. Thank you, Haley. This was so much fun. I had such a great time sharing all of these thoughts and ideas, and I look forward to seeing you again soon. Thank you.
Awesome, Fred. Thank you so much. It's always a joy to have you here. To everyone watching out there, I hope you guys have a great weekend. Enjoy the rest of your Saturday. It is a beautiful day here in Houston, Texas, so I'm about to go enjoy it. If y'all have questions, reach out to us, take advantage of those resources, and I'll see you next week in some of our other upcoming events and the virtual happy hour.
Thank you.
Thanks, Fred. See you later. Everyone have a
Bye.
great weekend.